Over the past decade, Cathie Wood has proven herself to be a leading investor in today's financial markets. Although Cathie has been in the investing space for decades, it wasn't until recently when she started gaining traction. In the meantime, the critics against Cathie have also garnered substantial attention. Amidst the crowd of critics is none other than Peter Schiff, the founder and CEO of Euro-Pacific Capital, a brokerage advisor and broker-dealer. Peter is an outspoken man who has started wars with many prominent leaders, and one of which actually includes Elon Musk. This video will go in depth into a heated war initiated by Peter Schiff against Cathie Wood. Welcome to Cathie's Academy. If you're new to the channel, please consider subscribing for more content like this, and let's get right into it. Cathie Wood is extremely bullish on all 5 of ARK Invest's innovation platforms, which are blockchain technology, genome sequencing, robotics, artificial intelligence, and energy storage. One of these just happens to be the technology behind Peter Schiff's least favorite asset class, cryptocurrencies. Schiff is a major supporter of gold, and has been touting gold as a key for the US to have a strong monetary system. As cryptocurrencies rose, and especially Bitcoin, his hatred for cryptos only grew more and more. At the beginning of January of this year, he said, "For years, I've argued with Wall Street economists, academics, and financial professionals that a monetary system based on gold is superior to one based on fiat. But never have I heard more preposterous arguments against gold than the ones I'm hearing now from Bitcoin advocates." In other words, Schiff is calling Bitcoin advocates delusional. However, Schiff didn't start targeting Cathie Wood until recently. In March of 2021, Cathie Wood went on CNBC to say that Bitcoin was most correlated with real estate. In Cathie's opinion, going forward, Bitcoin may be more correlated with fixed income assets like bonds. Peter responded to this statement on his podcast, The Peter Schiff Show. He called it one of the most ridiculous statements he has ever heard.
She said right now, the asset to which Bitcoin most correlates is real estate, which, makes no sense whatsoever. I mean, how is Bitcoin like real estate? I mean, first of all, real estate doesn't really trade. I mean, you see Bitcoin can go up and down 20% in a day. I mean, that doesn't happen in the real estate market. So I don't even know what she's talking about unless she's looking at a long-term chart, maybe 10 years, and saying, hey, Bitcoin is up over the last 10 years, and so is real estate, and therefore they're correlated, which makes no sense whatsoever, other than the fact that real estate is also in a bubble. But to say that Bitcoin is correlated to real estate is completely ridiculous. I mean, how is this woman supposed to be so smart, yet she makes an observation so dumb?
On the surface, Peter's argument makes a lot of sense. Bitcoin being correlated to real estate is quite strange, to say the least. However, a deeper dive shows that this argument is taking Cathie's statement out of context. In the interview that Peter is referring to, Cathie mentioned that Bitcoin is not highly correlated to anything at all.
What's been interesting about the correlations, Bitcoin to any other asset class, is the correlations have actually been very, very low over time. In fact, the highest correlation is between Bitcoin and real estate. We do think it will behave, actually, I would say, more like the fixed income markets, believe it or not.
Based on the data, Bitcoin is definitely not correlated to the other assets in the financial markets. This is a chart showing the price of Bitcoin, the S&P 500, a bond ETF, and a real estate investment trust over 6 months. As you can see, Bitcoin's price is not correlated at all to the other assets. And even on a 1-month chart, Bitcoin remains an outlier from the group. Nevertheless, Peter had more to say. He explains that all she did was load up on the most well-known, overvalued stocks in the bull market that bubbled up. Let's see how she performs during a bear market. I'm not here just to oppose Peter's arguments, but there is a major flaw in this statement. Cathie Wood was actually a portfolio manager during both the dot-com bubble and the 2008 recession. From 2001 to 2013, Cathie served as a chief investment officer at AllianceBernstein, where she generated an average annual return of 5.6%. This was slightly higher than the S&P 500's return of 4.2% per year over the same time frame. Of course, this isn't the best, but not the worst. After compounding this return on a 12-year basis, we can see that Cathie outperformed the market by roughly 28%. Clearly, Cathie Wood didn't perform the best. This was mainly because she failed to time the housing collapse in 2008. In 2006, she predicted the housing crash and scaled back on her funds. However, in 2007, after underperforming in 2006, she reversed her fund. By 2008, her fund crashed 45%. The main criticism of Cathie Wood from Peter is that she is just investing in stocks that everyone else has. On Peter's podcast, he explains this argument in depth.
It's not like she is uncovering some hidden gems. She's finding these innovative companies that nobody really knows about, and then she's buying them before the crowd finds out about it. I mean, she's buying the stocks that the crowd is already in and that the crowd continues to pile into. Her strategy is just to buy the most expensive, overhyped, overvalued stocks and just hope they keep going up.
Peter's argument centers down on the fact that a lot of retail investors own the same stocks as ARK Invest. This is definitely true to a certain extent. Most notably, Tesla had a lot of retail investors before it rose significantly in value. However, in my opinion, this isn't a problem at all. As long as fund managers crush the S&P 500 and generate enormous returns using reasonable investments, there shouldn't be any complaints. With that being said, we need to see Peter's returns as well, because he's obviously taking a stab at Cathie Wood. But first, I want to show you the elephant in the room. For those of you who don't know, Peter has been warning about a crash over and over again for years. Take a look at some of the books that he has been selling. 2007, Crash Proof, How to Profit from the Coming Economic Collapse. 2009, Crash Proof 2.0, How to Profit from the Economic Collapse. 2010, the same book again, Crash Proof, How to Profit from the Coming Economic Collapse. 2011, the same book again, Crash Proof 2.0, How to Profit from the Coming Economic Collapse. 2014, The Real Crash, America's Coming Bankruptcy, How to Save Yourself and Your Country. 2016, What Do You Know? The same book again, The Real Crash, America's Coming Bankruptcy, How to Save Yourself and Your Country, updated for 2016. Just like Harry Dent, another market crash predictor, Peter Schiff is a broken clock. That book list is honestly really embarrassing. Now what are Peter's returns? At first thought, I already knew they weren't going to be great, because he has been protecting himself from the quote-unquote next great crash for years. If anything, they must be negative. Peter Schiff always talks about inflation and the implications of high inflation ahead. However, his funds are offering the opposite of inflation, because his funds are literally deflating in value. His company Euro-Pacific Capital offers 5 mutual funds, which have all had awful performance over the past decade. His Europac International Value Fund is literally down 4.4% since inception in April of 2010. Not only that, but the fund also has an expense ratio of 1.75%, which is definitely not warranted after looking at his returns. If you don't know what an expense ratio is, this means that every year, Peter receives 1.75% of the amount of money in his fund, regardless of whatever horrible performance he had. Additionally, his International Dividend Fund is down 8% since January 2014. That dividend fund has an expense ratio of 1.52% and a dividend yield of 2.06%. As a result, his dividend fund, which is supposed to give investors an above average dividend yield, only gives roughly 0.54% per year in dividends. Even his best performing fund is only up 64% since inception in December 2010. What's even more embarrassing is that his international bond fund is down 11% since inception in November 2010. This international bond fund has a 1.15% expense ratio and a 1.11% dividend yield. So it literally has a higher expense ratio than the dividend yield itself. This quote-unquote expert predicted the 2008 recession and thought he was the king of the financial world. Ever since then, Peter's been predicting crashes every month. I don't know how this guy gets any credibility at all. He is literally saying the same thing over and over again. In the middle of May, he called Cathie Wood a clueless economist, but at this point in his career, he should be saying that to himself.
She thinks she's as brilliant as all the press clippings about her brilliance. So she is not objective. She cannot see clearly what is going on. Just like, the type of mentality that people had during the dot-com bubble. So I don't think she's actually lying. I think she actually believes this, and it's very unfortunate, not only for herself, but it's very unfortunate for people who have followed her into these funds.
Peter then claims that Cathie Wood's innovation fund, ARKK, would collapse over 50% to its 52-week low. Since then, ARKK has only continued the rebound from its low prices a month ago.
Because it used to be 160 and now you can buy it for 103. 160 was ridiculous. 103 is just less ridiculous. The fund is going down. The 52-week low is $54.31, and I bet that before the year is over, that fund takes out that low.
In my opinion, it's not unlikely that a crash of some kind will happen in the next year or two. It could be a 10 to 20% correction, a recession, or just a sector-oriented crash. but all of that is natural within the long-term economic cycle. And if Peter thinks that ARKK will go below $54 per share, then he should put his money where his mouth is and initiate a short position on the ETF. At first, this was going to be a video contrasting the arguments of the two individuals, but a deeper analysis of Peter Schiff shows that he is simply outclassed in skill. Cathie predicted that lumber prices were going to collapse. 1 month later, lumber prices collapsed. On the other hand, Peter thought that lumber prices were going to continue skyrocketing. Even short-term trends like lumber prices were predicted correctly by Cathie Wood, a long-term investor, whereas Peter, a short-term predictor, failed miserably. Today, Peter is touting his 2008 prediction as if he knew it all along. However, as we can see with his predictions, he is a broken clock that always shows the same time. Let me know whether you think Peter Schiff has any credibility down below. If you're interested in my personal research reports, my buy and sell alerts, how I navigate my new $25,000 portfolio, which I have a goal of growing to $100,000, exclusive valuation spreadsheets, and my main portfolio, check out my Patreon in the first link down below. If you enjoyed this video, please hit the like button and subscribe, and I'll see you in the next one.